Global stock markets fell in February quite sharply, and one of the main reasons that the fall was attributed to were growing concerns that interest rates and inflation may need to rise more than previously expected. Now, whether that transpires to be the case remains to be seen. There are certainly still some very significant deflationary trends in the world today which are structural. There's a very high stock of debt still. You've got aging demographics. We're all getting older, particularly in the developed world. And innovation is on the rise, which is holding prices down, the Amazon effect, if you will. But I think in the context of the last few weeks, it's worth discussing some of the characteristics that we think are important for a company or a share of a company to protect investors from rising interest rate and rising inflation environment. And for me, I think there's four key factors. The first is balance sheet strength, and quite simply, if a business has a low level of debt or no debt at all, as the cost of interest rises, it will be much more insulated from that trend than a heavily indebted business. The second factor is pricing power, and we tend to find that businesses that operate in quite mature, well-established industries tend to be able to raise prices at inflation or better over time, particularly where the products or services that they sell have a scarcity factor in terms of their customers' perception. The third factor is a low capital intensity, and this might seem like a slightly subtle point, but asset-light businesses were, for instance, very good at coping and dealing with inflation in the 1970s because the requirements in terms of replacing their asset base were much lower relative to their cash flow than a more asset-heavy business model. So those three factors are all fundamental factors, and we think equip a business well to grow its real free cash flow even when inflation and interest rates are on the rise. The final factor, last but certainly not least, is valuation. And clearly, valuation is always an important factor, but we think particularly when interest rates are rising, bond yields will probably be rising too. There's equities look less attractive on a relative basis, and therefore we think it's particularly important that you have a high margin of safety in terms of valuation. A key metric for us is free cash flow yield. We much prefer businesses that are trading on an attractive initial free cash flow yield from which they can then grow in real terms both their free cash flow stream and therefore their dividend stream for investors over time.